Hello there.
Today we're going to talk about moving averages. For those of you who don't know, a moving average is just a line that we place on our stock chart that moves up and down in waves across the stock chart, and it's the closest thing that we have to represent the price of the stock over a selected amount of time. And what I mean by selected amount of time is that we actually can select the amount of time that the moving average represents. So for example, if we want to figure out what the average price of the stock is for the past 20 days, we take a 20-day moving average, we stick it on our chart, and that will give us the average price of the stock over the past 20 days. Wherever the line lies, you can actually click on your chart and it will usually show you what the actual average price is. There are two main forms of moving averages that technical traders use on their charts. That's the simple moving average and the exponential moving average. The simple moving average is calculated by adding up the closing price of the amount of days selected and then dividing that number by the amount of days selected. So if we were to use a 50-day moving average, for example, each time a new day passes, the last of the days drops off the calculation and the new day is added to the calculation and then recalculated. This is what causes the average to move and reflect the current price. The exponential moving average is also a moving average, but is calculated slightly different than the simple moving average due to having an added weight factor into the formula. The main difference between the simple moving average and the exponential moving average is that the simple moving average gives equal weight to all prices within the specified amount of time, and the exponential moving average gives more weight to recent prices within the same specified amount of time. Moving averages can also act as support or resistance due to the fact that many traders are watching them, following them, and taking them into consideration while performing their technical analysis. Many algorithms are designed to use moving averages in a similar manner. We use simple moving averages on our higher time frames, like our daily charts. And since we want a moving average with a faster reaction time that takes into consideration more recent price action, we use the exponential moving average on lower time frames such as our intraday charts. For example, like a 5-minute chart, a 2-minute chart, or like a 1-minute chart. A great tip for using moving averages is to find a stock that actually reacts to the moving average. For example, if you're trying to use a moving average as support, but you're constantly seeing the price of the stock break through that moving average, then it's not really reacting to it very well. In that case, you want to use a longer term moving average that actually is reacting to the stock's price. Another tip is that it is important to figure out what type of trading you're trying to do. If you're trying to make very quick trades, then you want to be using a shorter term moving average like a 9 EMA or a 20 EMA. If you're trying to make longer term trades that may last for months or years, you may want to use something like the 50-day simple moving average or the 200 simple moving average. Moving averages can also help you identify trends. If the stock is above the moving average and trending above the moving average, and you can see that that moving average is sloping upwards, then we know that the trend is up. If the moving average starts to shift directions from moving up to moving sideways, that may indicate that the stock may actually be ready to start declining as well or changing directions. I hope that helped you have a better understanding of what moving averages are. I'll see you in the next video.